But our next guest is actually looking towards 2022 to get a sense of what the year ahead might bring. Michael Arone is the Chief Investment Strategist at State Street Global Advisors. And Michael, I'd love to start with that point that, and you kind of write, the cloudier the outlook, the longer the horizon along which one needs to look. And so, how far out are you trying to think about the dynamics that might shape risk assets, especially since we've seen kind of the optimism for 2021, to your point, pulled into 2020 for the most part?
I think that's the point, is that we've all kind of underscored this idea this year more than any other year that the market is a forward-looking mechanism. And that was clearly on display as investors were largely able to ignore some of the challenges from the pandemic to look ahead to what was going to be a pretty good earnings and economic recovery, the inevitable defeat of the pandemic, and all this amazing, massive amounts of both fiscal and monetary policy. So, Miles, if we take that logic just one step further and we think about next year, really what's going to drive next year's asset price performance, stocks most notably, is going to be how the economy, earnings, interest rates, and inflation are shaping up for 2022. And so from my perspective, I'm just simply trying to point out that if it is in fact a forward-looking mechanism, that's going to be the key determinants next year for how markets respond. And at least initially, I think that expectations are very high, very rosy, as they often are the further you look out. So I do think there is some downside risk potential coming off what was an unexpectedly good year this year.
Michael, do you think there will be an earnings estimate reset for the street for the first half of next year?
There always is. So I think that the expectations are that the earnings will be cut. And as a result, corporations and executives will be able to easily step over that lowered bar. And so what I think is interesting this year is that given that expectations are so high, and you have a lot of distortions given the pandemic, right? A lot of these sectors and industries are going to grow their earnings by more than 100%, in the energy space and materials, for example. But yet, many of them are going to remain below where they were at the start of 2020. So you have these distortions, you have markets at all-time highs, you have valuations that are stretched, and then you're going to have analysts cutting expectations. And we'll see what happens in terms of what we get for guidance. And again, I'm not trying to be all doom and gloom, shortly after Christmas here, but it does shape up for some disappointment at a time when the bar for expectations has been really high. And so I do think that is a contrast compared to last year. The bar was really, really low, and we easily surpassed it. This year, the expectations are really high, and it'll be interesting to see if we don't surpass them, what happens.
And there you have the opening bell, obviously, ringing at the New York Stock Exchange as we get underway with trading this morning. So, Michael, given the scenario that you're painting here, the market has obviously paid, you're talking about sort of the absolute level of where earnings are compared to the beginning of 2020. The market has ascribed value to the growth rate, right, rather than that absolute level. Does it start to care about that absolute level again? Does it matter if we get back to that? And if we are vulnerable, kind of after the year that we've had, do you think then that we're going to see a significant pullback either earlier in the year or going further in?
So I think that once we get back and we recoup to the levels where we started 2020, I think investors will be looking for the economy and earnings to continue that momentum. And I do think that there are some real structural challenges that remain. Debt levels, both public and private, will be much higher. Deficits much wider. $12 trillion in fiscal policy has been kind of raised throughout the globe to address pandemic challenges. We're not getting any younger, so the demographics continue to put a limit on consumption. And you'll still have the disinflationary forces of technology. So for me, once we get back to kind of the levels we saw at the beginning of 2020, end of 2019, it really is hard to see what the catalysts are to keep that momentum going. Remember, a lot of the fiscal policy benefits will begin to fade. And if markets continue to accelerate, inflation expectations pick up, the Fed's going to have to do something. And so a lot of these things I just think are risks. Now, that said, Julie, to your question about I'm not seeing a major pullback. I think the foundation for markets still remains fairly healthy in terms of the pandemic will end, the economy's recovering, the fiscal and monetary policy should keep things supported for a while longer. But I just think we're setting ourselves up for a little bit of disappointment potentially, and how markets will react, given that we're at all-time highs, given that valuations are stretched, will be interesting.
Michael, how impactful do you think the COVID plan that President Trump just signed, how impactful do you think that will be to GDP? Does it simply prevent a double-dip recession in the first quarter of next year, or is it the type of plan that truly drives the return of sustainable economic growth next year?
I think it's really the former, not the latter. So I think it will help us avert a double-dip recession. Certainly, it's going to help at a time that's normally seasonally difficult. So as we know, the first quarter from an economic standpoint, regardless of the pandemic, has always been a real challenge. And so I think this will help in that regard, even though we'll still see some challenges in the first quarter. And I think you'll really start to see some of the benefits from the fiscal policy package just signed kind of in the second and third quarter of next year. But I don't think it's the type of package that results in a sustained or persistent kind of acceleration in the economy. So even with the tremendous strides that we've made to repair the labor market, we still have a lot of wood to chop there in terms of increasing the number of jobs, getting the unemployment rate down, getting wages to accelerate again. So I still think that there's still a lot that needs to be done from that standpoint. And this fiscal package will help, but I don't think it'll get us all the way there.
All right, Michael Arone, Chief Investment Strategist at State Street Global Advisors. Michael, thanks so much for joining the program this morning. Always great to get your thoughts.